Welcome back to another session with our best of breed managers. Joining us now is Junaid Bray from Luring Capital. Junaid is one of the 4 portfolio managers on the Nedgroup Investments SA Equity Fund. Good morning, Junaid. Welcome.
Morning, Mansoor. Thanks for having me.
Performance this year has been quite strong, and I've looked at some of the numbers, even going back 1 year. Maybe just to start off, can we go into some of the performance numbers of the fund?
Sure. So if we look at the performance of the fund, we've had a decent run in our markets this year. So the markets are up about 16% year to date to the end of June. That's the JSE Caps Wix. Our funds kind of just matched that year to date and ahead of the peer group. And then about 22% over 1 year, also ahead of the peer group. And so we've compounded at about 15% for the last 5 years. That's what our market's done.
What's really interesting, though, if I look at those performance numbers, though, is those hit rates, the rolling 3 and 5 year periods. Those have been quite consistent.
So that is a number we track because we try to look at it, take out the short-term noise. So if you look at over rolling 5-year periods, and this fund's been running for over 11 years now, so you've got quite a lot of those 5-year periods rolling. For about more than 2/3 of the time, we've outperformed the benchmark and our peer group over the rolling 5-year periods.
Which I think is something actually you want to see in a fund, right? Maybe if we look at some of the stocks in the portfolio now, what has driven the fund performance? If we look at back over the quarter, if we look at the distribution.
So if I look at over the year-to-date period, so we've had a strong run in the gold price and PGM prices as well, and that's obviously lifted the stocks. So we've had a reasonable exposure to gold in our portfolio as well as PGMs, which we've held on to for some time. So Anglo Gold delivered quite nicely. Some of the PGM stocks, Impala, Northam, and then Naspers in process has performed very well this year to date, and we'll touch on a bit about that. And Anheuser-Busch as well, performing quite nicely. And then some of the stocks that have detracted on a relative basis were mostly stocks that we haven't owned that have performed well. The likes of, we've had low exposure to MTN or Capitec, Harmony. The only ones that we owned really that's detracted has been some of the domestics which have come under pressure in the recent past, and those are mostly FirstRand and Foschini Group.
You've alluded to some of the drivers of the local market, and we'll get onto that in a second, but just to maybe contextualize the local market performance, maybe if you compare that to, say, some of the other major indices, how does that stack up?
So I think it's an interesting point, Mansoor. I think if we look at there's the perception that our local markets have underperformed and haven't kept up with developed markets. So if we look at the performance in dollars of our market, so year to date, it's been 16% in rand, but we're given some rand strength and dollar weakness actually. We've seen that our market's up almost 24% in dollars year to date. So that's outperformed the MSCI World Index, the S&P 500 and emerging markets. And then we've had a very strong 12 months. So our market's up 28% in dollars in the last 12 months. And then on a 5-year basis, we've compounded at almost 16% in dollars, which pretty much almost matched the S&P 500. Now, yes, going back 5 years now, you are capturing, we had quite a drawdown in COVID, and you are capturing some of that in the base. But, the perception that our markets have not caught up or kept up with some of the stronger global markets, we have kept up, and the market's been quite strong.
Definitely some food for thought there. You alluded to some of those drivers of the local market to dig into some of those things now. Gold and PGMs in particular has come alive suddenly. Maybe your thoughts on gold and PGMs and whether this increase in price that we've seen over the last year, even a bit further than that, is this sustainable?
I think that those are interesting questions given the composition of our market and how important both gold and PGMs have become. So if we look at that 16% year to date, gold's contributed almost 16% of that 16%, and PGM's another 3%, and then Naspers in process also been a strong contributor. So I think about 9% of the 16% just comes from gold and PGMs. So we know that the gold price has been strong. The PGM prices, especially platinum, year to date has rallied quite a lot, from about under 1,000 to where it is today. And if we look at maybe just focusing a little bit on gold, so I think gold it's very different from other commodities because it's largely sentiment driven, rather than pure supply and demand for industrial metals. And with all the uncertainty that's been happening around the world, the tariff negotiations, etc., and the weakening dollar, gold's been a safe haven in that environment, and gold's benefited from that. So you've seen that inflows from an ETF perspective, from retail investors, as well as from central banks. So I think if you look at the one chart on the left, which highlights how central banks have been buying, and in the last 3 years you can see the elevated level that central banks have been buying, and really central banks looking at diversifying away from the purely dollar reserves, and gold's been picking up quite strongly. So it's very difficult to make a bet against gold given all the the issues that we've just spoken about right now. So we don't go investing on purely on speculating on where the gold price is going, but given where the spot gold price is, the equities still look relatively attractive, trading at double-digit free cash flow yields. So we don't think they're pricing in fully the current gold price if it's maintained. Then to answer your other question, Mansoor, on PGMs, it's one of the reasons we've actually held PGMs in our portfolio for some time now. I think the sell-off that we saw in PGMs in the last 2-3 years was largely off the back of the heightened electric vehicle penetration rates that we saw, especially in Europe, China as well. There was expectations that globally that was going to be the trend and that was going to pick up. And yes, we are going to see more EVs on our roads. But I think the expectations of, if you look at the chart on that we've pulled up on the right side, how the expectations of where we'll be by 2030, those have gradually been coming down. And that was our view, that, we weren't going to meet those targets. As soon as government started taking subsidies away, we've seen a slower penetration pick up in electric vehicles. And then with the lower price environment, we've seen the mines hold back. There's no new supply really coming online. And during COVID, the recycling, which comes largely from recycled vehicles or scrap vehicles, that's also fallen off. People are holding onto their cars longer because cars have gone up and they're more expensive, and there was a shortage of vehicles through the COVID period, in the early stages of the COVID period. So their deficit's expected for the next couple of years. So the market's expected to remain in deficit, and we've seen, despite the deficits at the producer level, there was a buildup of stocks or inventory from vehicle OEM manufacturers, and we anecdotally it seems to be that those stocks have unwound, and that's why the market's gotten tighter, and you're seeing the prices pick up now. So PGMs, we think that the outlook still looks quite positive from where we are.
So definitely some tailwinds for the metals that you think, in your opinion.
Both the gold and PGMs, yes.
What does that then translate into, higher gold, higher PGMs? What does that mean for SA as a country?
So it's a good question, Mansoor. So I think if you think about our terms of trade, which is largely our exports less our imports, gold and PGMs is still very important for us. I know gold, over the last couple of decades, our production has been declining, so it's not as big as it used to be in the past. But I think if you look at the last couple of years, still high single digits, so sort of 7-ish% of our exports is still gold, and then PGMs maybe another 9%. And at these higher prices, it'll be even more. So call it almost 16 to 20% of our export basket still comprises the gold and PGMs. And then, so what we look at, if we call it the terms of trade, and as a proxy for terms of trade, we've just taken really the gold and PGMs, less oil, because oil is our big import, and oil products generally is around 20%, so they're almost matched. And just as a proxy of where that's going, because obviously we only see the terms of trade with a lag of about a couple of months, that's expected at these higher prices to be quite high. Now there's a couple of positives for South Africa with that. The one thing is obviously the tax receipts and royalties, that as the miners earn more, the government gets a boost from higher taxes and royalties, and that does take some pressure off the fiscus, because remember that the last round of budgets we nearly had to go through with a VAT increase. Maybe that pressure's off the table for next year, especially if these prices sustain, then you get a sustained higher intake from that front. And then historically there has been a correlation with consumer spending, household consumption, with a lag. because as that money starts flowing through the economy, and the miners, the tax receipts, and then some of that earnings eventually comes through. And we've got a chart here with the bank serve take home pay, and you could do the terms of trade against household consumption as well, and it shows a similar pattern with a lag. Eventually it comes through a lag of about 9 to 12 months that comes through the economy. So if these prices are sustained, you could see a positive effect coming through our economy.
That sounds quite good. I think, if you look at the consumer, which has been under pressure, coming back to a sort of more macro level, have we seen actual tangible evidence of reforms in the economy in SA? I mean, a lot of this sounds positive, but are you seeing any evidence of change or reform?
So that's a very good question, Mansoor. We obviously, last year post the GNU formation, there was a lot of positivity in our market about structural reforms. And then, yes, we've had a couple of wobbles about the GNU and, concerns about does it remain intact? And those are valid questions. But I think, look, you're always going to have with a coalition government, the nature of coalition governments, you've got different parties with different ideologies trying to work together. There will be hiccups along the way. We still think our base case is that the GNU stays intact. But I think it does set the scene for structural reforms over time. It may not have been coming through as fast as some of us expected, but there are pockets, for example, the Department of Home Affairs. There's some very good work that the minister's been doing there. I think that if we look at some of the reforms had started being put in place even prior to the formation of the GNU, the government had Operation Vulindlela, and some of those reforms that started coming through. So if we look at, for example, we know load shedding is largely behind us, and we hardly talk about it anymore. And compared to where we were, a couple of years ago, I mean, it's certainly a lot less. Then we know that, our ports, there were some serious issues about port delays. If you look at that, port delays have come down quite a lot. So it does seem that we've bottomed there, as well as logistics on the freight side from Transnet. Those issues have also, the volumes does seem to have bottomed. And then there's still further investment over the next 3 years that will improve that further. So it does look like on those fronts we've bottomed, and there are tangible signs of improvement coming through.
Okay, so it's more incremental at this point. Yeah, coming back to the fund now, I mean, it sounds quite positive. Your outlook sounds quite positive. So how are you positioning the fund to take advantage of these sort of issues that's taking place now?
So I think if we look at our market, we've obviously got, we're seeing opportunity both on the rand hedge side as well as domestically. So if I look at the way the portfolio is positioned, the way we break up our overall market into 4 main buckets. On the global consumer side, we're still very positive on Naspers and Prosus, and we spent some time with them in London at the Capital Markets Day. I think it was very well received as to where they're driving the business going forward. It's a lot more operationally focused rather than a shotgun approach to investing and scattered investments. They're focusing on really driving change and improvement in the existing portfolio and getting that valuation uplift. So we're positive on that, and Tencent as well, which is still the key investment. Tencent, the outlook for Tencent as a real beneficiary of AI still looks very good. Then Anheuser-Busch, we think that it still looks very attractive on a 17 multiple. I think the outlook for the next couple of years will be double-digit earnings growth from them as they continue to de-gear. Bidcorp also looks very attractive. And then if you look at the SA Inc. bucket, that's where we're getting more excited as the valuations looking exceptionally attractive. The likes of ABSA and Nedbank trading at almost 10% forward dividend yields. So exceptionally attractive, and you earn that on top of the capital upside that we expect from those stocks. Then some of the other names we've got exposure to, Remgro, some of the retailers, Fushini Group, and then on the mining side, we've spoken a lot about the gold and PGMs. We're still holding on to those names in the portfolio, particularly Anglo Gold, Impala, and Northam. And then Anglo American, we still think with that copper portfolio and how they've cleaned up that portfolio still looks exceptionally attractive. So we're very comfortable and excited about the way the portfolio is positioned and the outlook for our stocks in the portfolio.
And if you look at the sort of overall composition within the various sectors of the portfolio, what does that look like?
So overall, those global consumer names, it's nearly 30% of the fund. Our banks are all about 20% of the fund, so a substantial position actually in banks. Retail is about 7%, gold stocks about 11%, and then 7% exposure to the PGM stocks. So you can see that's a substantial part of the portfolio just exposed to some of those names we highlighted earlier.
Thanks, Junaid. And I'm not sure about our viewers, but that gives me more food for thought to relook at my SA allocation within my portfolio. It's been a good update, Junaid. We thank you for your insights. Thanks for your time today.
Thanks, Mansoor.